Right now, as you watch this video, an advanced artificial intelligence system at the Internal Revenue Service is quietly scanning millions of ordinary bank accounts across the country. It is not looking for international tax evaders or corporate fraudsters. Instead, it is hunting for 7 specific, completely legal banking moves that regular seniors make every day, actions that look entirely innocent to you, but trigger an automatic devastating tax audit. If you are a retiree living on a fixed income, an unexpected letter from the government demanding years of financial records can completely shatter your peace of mind and wipe out your hard-earned savings in penalties and fees. The stakes have never been higher than they are right now because the government has recently poured billions of dollars into automated data matching systems that flag anomalies instantly, long before a human eyes your file. By the end of this video, you will discover the exact digital tripwires hiding inside your checking and savings accounts, including one incredibly common downsizing move that almost every retiree assumes is tax-free, but which the government computers view as a massive red flag for hidden income. Navigating the financial world as a senior has become a high-stakes game where the rules change without warning, and what used to be considered prudent money management can now land you in the middle of a stressful federal investigation. I have spent years studying the intersection of retirement planning and federal compliance, and I have seen firsthand how good, honest people get caught in these automated nets simply because they did not know the system was watching. Today, we are going to walk through the 7 silent banking triggers that are causing a historic surge in senior audits. We will break down exactly how these traps work, why the banking algorithms are programmed to flag them, and the precise, stress-free steps you can take to protect your assets and keep the government out of your private life. Let us begin with the first banking move that catches thousands of retirees off guard every year, an action driven by a completely natural desire to protect your privacy and maintain control over your cash. Imagine you need $9,500 to buy a dependable used vehicle or to help your grandchild pay for a semester of college. You walk into your local bank branch, speak with the teller, and withdraw the $9,500 in cash. You might think you are being smart by keeping the transaction just under the well-known $10,000 threshold that requires federal reporting. To you, it feels like avoiding unnecessary paperwork and keeping your personal business private. However, in the eyes of the automated compliance systems, you have just stepped directly onto a financial landmine known as structuring. Under the Bank Secrecy Act, financial institutions are legally required to file a currency transaction report for any cash transaction exceeding $10,000. The algorithm is designed to flag anyone who appears to be intentionally keeping their deposits or withdrawals just below that limit to evade the reporting requirement. When you make a withdrawal of $9,500 or perhaps 2 separate deposits of $5,000 within a short time frame, the bank's software automatically generates a suspicious activity report. The most terrifying part of this process is that federal law strictly prohibits the bank teller from warning you that this report is being filed. You will walk out of the bank with your cash completely unaware that a digital red flag has just been attached to your Social Security number. When that suspicious activity report hits the desk of an Internal Revenue Service analyst, the immediate assumption is that you are hiding income or operating an undocumented cash business. Suddenly, you receive an audit notice demanding that you prove exactly where that cash came from or what it was used for, forcing you to dig up old receipts and bank statements from years ago. To protect yourself from this trap, the solution is absolute transparency. If you need $11,000, withdraw $11,000 all at once. Let the bank file the standard currency transaction report. It is a completely routine piece of paperwork that signifies nothing more than a large cash move, whereas attempting to split or reduce the amount to stay under the radar guarantees you will look suspicious to the computer algorithms. That brings us directly to the second silent trigger, which is perhaps the most emotionally painful because it stems from a place of love, family protection, and planning for the inevitable. Many seniors, as they grow older, decide to add an adult son or daughter as a joint owner on their primary checking or savings account. The logic seems flawless. You want to make sure that if you ever become ill or hospitalized, your child can easily access your funds to pay your mortgage, cover your utility bills, and manage your medical expenses without having to jump through legal hoops or wait for a court-ordered power of attorney. While this move makes perfect sense from a family caregiving perspective, it creates a massive legal and financial blind spot that the tax authorities exploit constantly. The moment you place your child's name on that bank account, they legally become a co-owner of every single dollar sitting in that vault. This means that the account is no longer just your private retirement fund. It is now tied directly to your child's financial history and tax profile. If your adult child happens to owe back taxes, faces a business audit, goes through a messy divorce, or gets hit with a legal judgment from an accident, the government and creditors view that joint bank account as an asset available for seizure. Furthermore, if your child is self-employed or has a regular income and they deposit their own money into your joint account to help you out or just for safekeeping, the automated tracking systems see a massive influx of cash that does not match your reported retirement income. The system flags this as potentially unreported income belonging to you. When the audit triggers, you are the one who has to sit across from an auditor and prove that the $50,000 deposited into the account over the past year belonged to your child's freelance business and was not your own secret, untaxed earnings. The stress of proving a negative can take a massive toll on your health and well-being. Instead of taking the dangerous route of a joint bank account, a far safer and more sophisticated approach is to establish a durable power of attorney. This legal document grants your child the exact same ability to manage your finances and pay your bills if you become incapacitated, but it keeps their personal financial risks entirely separate from your retirement nest egg. Consider how frequently you hear about the benefits of moving your money around to maximize your returns. This leads us to our third innocent banking move, which has become incredibly common in recent years due to the rise of online banking and shifting interest rates. Many retirees living on fixed incomes are highly motivated to stretch their dollars as far as possible. If you see that an online bank is offering a significantly higher yield on certificates of deposit or high-yield savings accounts than your traditional brick-and-mortar bank, it seems completely rational to move your money to capture that extra interest. You might withdraw $50,000 from your local bank, move it to an online institution, and then a few months later move it again when another bank offers a better promotional rate or a sign-up bonus. To you, this is just smart, proactive financial stewardship. You are simply managing your own hard-earned money to outpace inflation. But look at this exact same behavior through the lens of an automated fraud detection algorithm. To the computer, the rapid movement of large sums of money back and forth between multiple financial institutions looks exactly like a classic money laundering technique known as layering. Layering is the process of moving funds through a complex web of accounts to obscure the original source of the cash and make it difficult for law enforcement to track. When the software sees a senior rapidly opening and closing accounts or transferring large blocks of capital across 3 or 4 different banks within a single tax year, it flags the behavior as highly anomalous. The system automatically wonders why a retiree with a stable, predictable income stream is suddenly behaving like a high-volume financial trader. This data mismatch frequently triggers an asset verification audit where the government demands a complete, unbroken chain of custody for every dollar moved. If you cannot perfectly document every single transfer, or if one of the banks failed to issue the correct tax forms, you could find yourself facing steep penalties and prolonged scrutiny. To avoid this digital trap, try to limit your major banking transitions. When you do move funds to capture a better interest rate, ensure that you keep a dedicated physical or digital file containing every single bank statement, transfer confirmation, and account closure letter, allowing you to instantly prove the clean, legitimate path of your money if the automated system ever calls your file into question. Let us pause for a moment and look at how much our daily lives have shifted toward technology. Have you noticed how almost every business, family member, and friend now prefers to handle money electronically rather than using traditional cash or paper checks? This shift brings us to our fourth innocent banking move, which centers around the casual use of modern peer-to-peer mobile payment applications like Venmo, Zelle, or PayPal. Many seniors have embraced these apps because they make it incredibly easy to interact with family and friends. Suppose you go out for a celebratory anniversary dinner with your extended family and you kindly put the entire $400 bill on your credit card to earn loyalty points. Afterward, your children and grandchildren use Zelle or Venmo to send you their shares of the dinner cost. Or perhaps you go on a group vacation with your retired friends and you manage the lodging bookings, resulting in your friends sending you thousands of dollars via these apps to reimburse you for their portion of the trip. In your mind, these transactions are completely net zero. You spent the money up front, and your loved ones are simply paying you back for personal non-business expenses. No one is making a profit, and no commercial business is being conducted. However, the regulatory landscape surrounding these digital payment networks has shifted dramatically. Automated systems now monitor peer-to-peer payment networks with extreme precision, specifically looking for high volumes of incoming transfers or cumulative amounts that exceed specific thresholds. If the algorithm sees a steady stream of electronic deposits hitting your bank account from various individuals via mobile apps, it does not see a friendly dinner reimbursement or a shared vacation pool. It sees an unreported commercial enterprise. The IRS computers are programmed to cross-reference the total volume of these digital inflows against your reported tax return. If your return shows that your only sources of income are Social Security and a modest pension, but your bank ledger shows $10,000 or $15,000 in annual peer-to-peer electronic transfers, the system instantly flags a gross income mismatch. You could find yourself facing an audit where the government assumes you are running an unregistered business or selling goods under the table, placing the burden of proof entirely on your shoulders to demonstrate that every single one of those digital transfers was a non-taxable personal reimbursement. To shield yourself from this modern trap, always ensure that when friends or family send you money through these apps, they explicitly utilize the personal or gift setting rather than the business or services option, and make sure they write a clear, unambiguous memo in the notes section, such as dinner reimbursement or shared vacation cost, creating a clear paper trail that can easily deflect an automated system flag. As we move deeper into these hidden triggers, we encounter our fifth innocent move, which specifically impacts seniors who have international family ties, own property abroad, or love to travel extensively during their golden years. Many retirees, often referred to as snowbirds, choose to spend their winter months in warmer climates like Mexico, Central America, or the Caribbean, or perhaps they have relatives living overseas whom they support financially. Suppose you decide to wire $20,000 from your domestic bank account to a foreign bank to pay for a long-term rental property lease, or you receive a legitimate inheritance from a deceased relative's estate located in Europe, which is deposited directly into your local checking account. To you, this is a completely legal, transparent transaction involving legitimate post-tax funds. You are not trying to hide wealth offshore. You are simply funding your retirement lifestyle or receiving what is rightfully yours. Yet the moment a financial transaction crosses an international border, it enters a hypersensitive realm of federal surveillance governed by financial crimes enforcement networks and the Foreign Account Tax Compliance Act. The global banking network operates under incredibly strict automated monitoring guidelines, where any cross-border wire transfer over a certain amount or a series of frequent smaller international transfers triggers an immediate mandatory review. The primary danger for seniors is that these international banking moves often carry hidden, highly complex disclosure requirements that the average person is completely unaware of. For instance, if you hold funds in a foreign account to pay for your winter home expenses, and the aggregate value of that account exceeds $10,000 at any point during the calendar year, you are legally required to file a report of foreign bank and financial accounts, commonly known as an FBAR. Failing to file this form, even out of pure innocent ignorance, carries catastrophic penalties that can easily wipe out your entire account balance. When the automated banking systems detect international activity that is not perfectly matched by corresponding disclosure forms on your annual tax return, the system triggers a comprehensive lifestyle and asset audit. Suddenly, you are forced to hire specialized international tax attorneys just to prove you are not a financial criminal, costing you thousands of dollars in unrecoverable professional fees. If you plan to move money internationally, you must consult with a qualified professional beforehand to ensure every single required disclosure form is filed proactively, ensuring your international retirement dreams do not turn into a bureaucratic nightmare. We must also look at how seniors interact with the causes and institutions they care about most. This leads us to our sixth innocent banking move, which involves a deeply generous impulse that can accidentally distort your financial profile in the eyes of tax software. Many retirees are highly philanthropic, dedicating a portion of their fixed income to supporting their local church, a favorite charity, or a community nonprofit organization. To make things simple and convenient, you might set up an automatic monthly recurring transfer directly from your checking account to the charity, or you might write large physical checks directly out of your primary bank account at the end of the year to maximize your charitable impact. You do this with an open heart, fully intending to claim these legitimate donations as deductions on your tax return to help offset your tax liability. The hidden complication arises from the way the automated tax system evaluates itemized deductions versus the standard deduction for seniors. Ever since the standard deduction was significantly increased, the vast majority of retirees no longer receive any actual tax benefit from itemizing their charitable gifts because their total deductions do not cross the high standard threshold. When you claim a large charitable deduction on your return, but but your bank records and the corresponding automated reports submitted by the charities do not perfectly align with the specific electronic reporting formats expected by the IRS, the system flags a mismatch. Even worse, if you are over the age of 70 and a half, making large charitable donations directly from your regular bank, checking account is a massive missed opportunity that looks highly inefficient to tax algorithms. If you have a traditional individual retirement account, you are required to take minimum distributions each year, which are taxed as ordinary income. If you write a check from your personal bank account to a charity, you are using money that has already been taxed, or money that will be taxed when you withdraw it from your retirement account. If the automated system sees large blocks of cash, leaving your bank account destined for charities while you are simultaneously taking taxable distributions from your retirement account, the system's financial efficiency algorithms flag your return for a closer look, often suspecting that you are confusing different types of accounts or improperly sheltering income. The sophisticated audit-proof way to give back is to utilize a qualified charitable distribution. This allows you to instruct your retirement account custodian to transfer the funds directly from your IRA to the qualified charity, completely bypassing your personal bank account. This move counts toward your required minimum distribution, is completely excluded from your gross income, and generates a clean, automated reporting trail that keeps your personal bank account perfectly stable and entirely below the radar of audit algorithms. Before we reveal the final, most dangerous, and highly counterintuitive banking move that seniors make every day, let us take a moment to reflect on a major milestone that almost every retiree eventually faces. Think about the physical items, the collections, and the property you have accumulated over 40, 50, or 60 years of hard work. There comes a time in every senior's life when it makes complete sense to downsize your living situation, whether you are moving into a smaller, more manageable home, transitioning to a retirement community, or simply clearing out the clutter to simplify your lifestyle. This brings us directly to our seventh and final innocent banking move, the single biggest audit trap waiting for seniors today. Imagine you decide it is time to downsize. You have an attic, a basement, or a storage unit filled with items you no longer need. You might have a valuable collection of vintage coins, rare stamps, antique furniture, or fine art that you have cherished for decades. Or perhaps you simply have a lifetime of household goods, high-end tools, and a reliable secondary vehicle that you no longer drive. You decide to sell these items either through a professionally managed estate sale, a local consignment shop, an online marketplace, or a private buyer. The sales are highly successful, and a private buyer hands you a cashier's check or a personal check for $15,000 for your collection or your vehicle. You walk into your bank, entirely proud of your hard work, and deposit that $15,000 check directly into your primary checking account. In your mind, this money is completely tax-free. Your reasoning is entirely logical. These were your personal used belongings that you purchased with your own taxed income decades ago. You are not a commercial business, you are not running a retail store, and you certainly did not make a profit on most of these items compared to what you originally paid for them decades ago when factoring in inflation. Now let us look at exactly what happens inside the automated tax processing center when that deposit clears. Your bank is legally required to report large, unusual electronic and check deposits to the government's financial tracking systems. The automated data matching algorithm immediately looks at your annual tax return and compares it directly to the total volume of deposits hitting your bank account. If your tax return states that your sole income for the year consists of $30,000 in Social Security and $20,000 from a pension, the system expects your total bank deposits to perfectly mirror that $50,000 total. When the system sees an extra $15,000 suddenly land in your checking account from an unverified source, a massive red flag is triggered. The algorithm does not know that the cash came from a lifetime collection of old furniture or a used car. The computer operates on a strict, unyielding assumption. Any unexplained banking deposit that exceeds your reported income is treated as hidden, taxable gross income until proven otherwise. This specific data mismatch triggers a comprehensive, highly invasive audit known as a lifestyle or bank deposit analysis audit. Instead of just asking you about a single line on your tax return, the government demands to see every single bank statement from all your accounts for the past 3 years. They will meticulously add up every single deposit, even the small $20 checks you received for your birthday or Christmas, and demand that you prove the exact source of every single dollar. If you cannot provide a definitive written paper trail showing exactly what was sold, what you originally paid for it decades ago to establish your cost basis, and proof that the item was sold at a loss, The auditor has the legal authority to reclassify that entire $15,000 deposit as fully taxable income. They will hit you with back taxes, substantial failure to report penalties, and compounding interest charges that can instantly drain thousands of dollars directly out of your retirement savings. The sheer panic of receiving this type of audit notice is enough to ruin a retiree's health and sense of security. To protect yourself from this devastating downsizing trap, you must build an airtight defense before you ever step foot inside your bank to deposit the money. Whenever you sell personal property or downsize your estate, you must maintain a dedicated physical ledger. Document every single item sold, take photographs of the items, note the approximate year you originally purchased them, and write down the exact amount you received. If you are selling a high-value asset like a vehicle, a boat, or a rare collection, ensure you have a formal bill of sale signed by both you and the buyer, explicitly stating that the transaction represents the sale of personal used property. When you deposit the check at your bank, keep that bill of sale clipped directly to your deposit receipt. By creating a flawless, professional paper trail at the exact moment of the transaction, you give yourself the ultimate shield, allowing you to instantly dismantle any automated flag and prove beyond a shadow of a doubt that your innocent downsizing move was entirely legitimate and completely non-taxable. To ensure your retirement remains entirely peaceful, secure, and free from government intrusion, let us briefly summarize the 3 most vital takeaways from what we have learned today. First, never attempt to alter, split, or reduce your cash transactions to stay below the $10,000 limit. Absolute transparency is always the safest path. Second, avoid the hidden legal dangers of placing adult children as joint owners on your primary bank accounts, choosing instead the clean, protective structure of a durable power of attorney. And finally, whenever you move large sums of money, receive international funds, or downsize your personal property, you must create a flawless, written paper trail with receipts and bills of sale at the exact moment of the transfer, ensuring you can instantly satisfy the automated algorithms before they ever turn into an invasive audit. Your peace of mind during retirement is incredibly precious, and no one should have to live in fear of a sudden automated letter from the government disrupting their lives. I want to hear from you now. Have you or someone you know ever experienced an unexpected question from your bank or a stressful notice from the IRS over a completely innocent financial move? Please share your story and leave a comment below so we can all learn from each other's experiences and build a stronger, more protected community together.